thing they can do. They can target other oil facility in the region. And the region produces a huge amount of oil. You have, of course, the UAE, you have Saudi Arabia, you have Kuwait, and so on and so forth, and you have Iraq. Now, the United States was very clear yesterday, any form of retaliation would be met with extreme force. So that, of course, increases the risk of a flare-up and of potential damage to oil facility in the region.
Even as we wait to see what Iran will ultimately do, we've already been seeing some signal disruptions, other sorts of disruptions as well in the Strait, maybe also because of shipping concerns going into the waterway. How much disruption are we ultimately already seeing at the moment?
So, I mean, what we're seeing is that first of all, ships now tend to go through the Strait of Hormuz on the Omani side, right? So this is the first and obviously the easiest thing to do. What we've seen is that some ships have been diverted, so they decided not to go through the Straits for the risk of being targeted. So up until the weekend, we hadn't seen any disruption in the flow. So that's the reason why the price was obviously we had a very high risk premium, but not extremely high. But what happened over the weekend clearly changes completely the dynamics, because right now we have the United States has entered the war on the side of Israel and against Iran, and this changes completely the dynamics, and therefore the situation is now completely changed. So we could see, as a matter of fact, a huge decrease in the flow of oil over the next couple of weeks. So we just need to monitor. At this point, it's so early that it's very difficult to assess. But what we can expect is that there's going to be a lot of volatility in the market in the next couple of weeks for sure.
Claudio, what do you think the likely response from OPEC Plus is going to be?
So OPEC Plus, this is very important, because what we have seen is that of course, we are going through an extremely volatile period in the Middle East. This is Israel attacked Iran already 2 weeks ago, and what we have said is that the OPEC Plus has a lot of spare capacity. So we're talking about almost 6 million barrels a day of production, which is kept offline as a result of the successive production cuts that the organization made over the past 3 years. So this is a very important cushion, because imagine there is a facility which is hit somewhere in the Middle East, maybe 100,000 barrels per day are basically taken out, but there is this 6 million barrels a day of capacity that can come online at any point in time. The problem, though, is that it all sits on north of the Strait of Hormuz. So even if this spare capacity is brought back online, it still need to go through the Strait of Hormuz. So this is very important to bear in mind. But it is a fact that at least we have the ability to deploy some capacity by OPEC Plus, which is considerable. Also, very important, Saudi Arabia can direct some of its production from east to west using a pipeline, bypassing the Strait of Hormuz. Also, the United Emirates, they can use a pipeline to Fujairah to bypass the Strait of Hormuz. Therefore, there is the ability to kind of address any problem through the Strait of Hormuz, but it's not going to be the 20 million barrels a day that go through the Strait of Hormuz on a daily basis. Probably you can redirect 6 to 7 million barrels per day. So it's Strait of Hormuz remains an extremely important deal right now at this point.
Right. That's a key point, having the spare capacity, but what about having it move around where it needs to go? Claudio Galimbati, Chief Economist at Rystad Angie, thank you so much for your insights. Now, China has criticized the U.S. strike on Iranian nuclear facilities, saying again that it's willing to join international efforts to restore peace in the Middle East. And U.S. Secretary of State Marco Rubio is calling on Beijing to ensure Iran keeps the Strait of Hormuz open.
Well, I encourage the Chinese government in Beijing to call them about that, because they heavily depend on the Straits of Hormuz for their oil. If they do that, it'll be another terrible mistake. It's economic suicide for them if they do it. And we retain options to deal with that. But other countries should be looking at that as well. It would hurt other countries' economies a lot worse than ours.
Good. All right.
Let's bring in our China correspondent, Min Lo, for us. So, Min, what are we hearing exactly from the Chinese side?
Yes, China has condemned the U.S. attack on Iran's nuclear sites. We know that China has previously called on the U.S. to do more to calm the conflict, but I guess attacking the nuclear sites isn't exactly China's vision of calming the conflict. In fact, there is a Global Times editorial that really criticized how the U.S. is escalating the conflict even more by entering the fray and using more higher level weapons to escalate things even further and destabilizing the region. And China says that Iran will likely see this as an act of provocation. It could threaten to spill over this conflict to the wider region. So China is extremely against this move from the U.S. But of course, analysts are saying that the fact that U.S. is engaged in this war in Iran, it is a distraction for Washington from the strategic competition with China. So there's a side benefit that China could reap from this in some ways. But China's stand is still the same as before. They strongly condemn the attack from Israel and from the U.S. They continue to call on all parties, especially Israel, to cease fire, and says that they are willing to do what they can to mediate or facilitate peace and stability in the region, but nothing beyond that rhetorical support so far.
Yeah, it's interesting that no sort of meaningful support has really been given in terms of beyond normal trade relations, right? But what do we know in terms of the outsized impact that any sort of Strait of Hormuz blockade would have on China in particular?
Yes, China relies on the Middle East for nearly half of its energy needs. And as you heard from the analysts earlier, China imports almost all of Iran's oil, crude oil. And so it does have some leverage over Iran. And as Marco Rubio also mentioned, it is in some ways economic suicide for Iran if it closes that Strait of Hormuz, given that 85% of Iran's exports come from its energy exports. So it's a very sort of critical choke point here. And as the analyst said, it could be quite difficult for Iran to actually close that. Iran controls the northern side of that Strait of Hormuz, and Saudi Arabia, Qatar controls the southern side of the strait. But China right now, according to official statistics, Russia is still China's largest source of energy imports. And it does have imports from other countries in the Middle East. And as the analyst mentioned as well, there are these alternative pipelines that Saudi Arabia and Emirates have, although the capacity is limited. According to the U.S. Energy Information Administration, they can free up additional about 2.6 million barrels of oil per day on average, but that's a drop in the bucket compared to what the Strait of Hormuz handles a day, about 20 million barrels a day. So, of course, markets are already pricing in the risk of potential disruption to oil flows.
Bloomberg's China correspondent Min Lo there with the latest. More ahead on the Asia trade. This is Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
The capitalist system is the best system in the world. There isn't another one that works as well.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Wall Street used to be a place. Now it's more of an idea. I hope you survived the day.
I did. It was a busy day.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Take a look at how we're setting up. We're just 15 minutes away from the start of cash trading here in Australia. We're seeing decidedly lower outlook when it comes to Asian stocks, likely to really follow the track of US futures lower there as well, as we continue to watch what goes on with the Strait of Hormuz and those risks to global oil flows as the Israel, Iran and now US involvement in this conflict continues. Well, the International Monetary Fund will also be closely watching the impact of the US strike on Iran. Let's get over to Tokyo.
And Heidi, perhaps lower and more pressure on the global economy, given, of course, the ongoing uncertainty, not only from geopolitical tensions, but also from the trade environment. Joining me now here is the IMF Managing Director, Kristalina Georgieva. Managing Director, great to have you here in Tokyo. Welcome.
Thank you.
It's very difficult to say right now how these geopolitical tensions in the Middle East will unfold. But at this point, what is the IMF watching very closely on how this could impact the global economy?
We are looking at this as another source of uncertainty in what has been a highly uncertain environment. And we are watching for two things. One, how would that impact risk premia for oil and gas? There has been some movement upward. How far would it go? And two, would there be any disruption in energy supplies? For now, no, but let's see how events would develop, whether either the delivery routes or spillovers to other countries may occur. I pray no.
Right. Is the transmission mechanism, the channels where you're seeing the biggest Middle East shock in energy prices at the moment?
It is in energy prices, yes. Of course, there could be secondary and tertiary impact. Let's say there is more turbulence that goes into hitting growth prospects of large economies, and then you have a trigger impact in a downward revision of prospects for global growth. As you know, we have already revised the downward growth projections for this year, and we will be coming up with our next projections in July. So far, what we see in the first 2 quarters of the year broadly confirms the picture we have painted in April, and it is somewhat slower global growth, but no recession.
Especially when it comes to the United States, you also upped the potential of recession risk in your last update in April.
Indeed. We went up to nearly 40% risk of recession. Yet, when you look at the probabilities, still there is a higher probability that the U.S. in this year may avoid recession. But please, let's not rock the boat any further.
Especially given that we have inflationary risk as well, right? Given that we do not know where energy prices will end up being, but at the same time, given the transmission mechanism, is stagflation risk in the U.S. a real concern?
For now, we see the disinflation in the United States continuing, but not to a point in which the Fed feels comfortable to cut interest rates right now. What we expect towards the end of the year is possibly for the Fed to apply judgment that time may have come for some adjustment of interest rates downwards. We are not seeing dramatic change in the U.S. Labor market remains strong. We see 4%, around 4% increase in pay. What does it translate into? Consumers feeling more comfortable to spend. But the more there is uncertainty, the more there is volatility, the worse it is for business. When there is uncertainty, what happens? Investors don't invest, consumers don't consume, and that holds growth prospects down.
And it really complicates the matter for the Federal Reserve, and yet you still expect them to at least be able to act if conditions were kept until the end of the year.
Well, I mean, inflation has been going down. It is almost to target. At the same time, there is a little bit of slowdown in economic activity, and that could lead the Fed to apply judgment that the time has come for some reduction in interest rates. But for now, they are saying, well, let's see what next, because as you said, we don't know whether there may be upward pressure from energy prices on inflation. We don't know whether the tariff situation would stabilize. There have been some positive steps, some agreements already in place, a commitment to continue to negotiate, but that has not yet been finalized.
The blanket tariffs, the pause ends on July 9th. We don't know which way that will go, right? We have seen this ongoing uncertainty and, of course, the geopolitics as well. A little bit it's of a lack of confidence when it comes to American assets, whether it's the U.S. dollar or treasuries and volatility around that. Do you expect that to continue? I guess my question is also something that has been asked a lot, the end of U.S. exceptionalism.
Well, let's recognize two things. One, the U.S. economy is very dynamic. It is an innovation-driven economy. It is one of the very few where productivity has been growing, much stronger than in the rest of the world. It has very deep and liquid capital markets, and it attracts financial flows for all these reasons. When we look at the size of the U.S. economy, say about a quarter of the world economy, and then we look at the size of financial assets in the United States, which is almost 3/4 of financial assets of the world, inevitably there would be some thinking maybe there has to be more diversification to other places. What is the problem? The rest of the world economy doesn't show the same dynamism and profitability for money to fly there.
Are you seeing more of that here in Japan?
I am impressed by what Japan has been doing over the last years. We have seen monetary policy normalization proceeding robustly, steadily. Japan's growth is very close to potential. We assess potential growth at around 0.5 percentage point. Japan, we expect to grow this year, maybe even 0.6%. But aging population and limits to that ability to offer more dynamism means that policymakers and businesses have to do more.
And it's so difficult for the Bank of Japan that's trying to normalize and hike rates, and we're seeing this divergent monetary path around the world. That brings its own risks.
It is a very different world today than what we had right after COVID. Right after COVID, we had central banks going in a lockstep. Monetary policy opened up more space for injecting liquidity in the economy. So monetary policy, fiscal policy, all over the world, pretty much doing the same thing. Now we are in a very different place when monetary policy around the world has to go in different directions. We have in some countries monetary policy some tightening. We see some countries actually losing, getting a bit more space through monetary policy. And why is this difficult? It is much easier if you can sit in your chair as a governor of a central bank, look around and say, everybody is cutting, I'm cutting as well. Or everybody is tightening, I'm going to tighten as well. Now we are in a place where everybody has to judge on data for their own conditions.
Managing Director, really good to have you here in Tokyo. Kristalina Georgieva joining us, of course, of the IMF here in Japan, Avril.
Sherry-Ann in Tokyo for us. Let's take a quick look at how futures are faring in the Asia Pacific. Likely to be a risk-off day based on what we're seeing. Plenty more ahead. This is Bloomberg.